At 6:11 a.m., the alarm rang. Daniel didn't move. He stared at the ceiling of his small apartment in Arlington, Texas, listening to the hum of the air conditioner and the quiet breathing of his wife beside him. For the first time in his adult life, he was awake before the market and terrified of it. On the nightstand, his phone vibrated. Pre-market volatility alert. Daniel closed his eyes. Because today wasn't just another trading day. Today was the day he was supposed to win everything back. Daniel wasn't a gambler. That's important. He didn't grow up around casinos or lottery tickets. He grew up watching his parents stretch paychecks, rotate credit cards, and argue quietly at night so the kids wouldn't hear. Money was always tight, never dramatic, just exhausting. At 29, Daniel had done everything right. College degree, stable IT support job, $52,000 a year. No luxury, no debt spiral. But also, no momentum. Rent kept rising. Groceries felt heavier every month. Savings moved slower than life. And then 2023 happened. The headlines were confusing. The news said, the US job market is strong, but Daniel's reality felt different. Friends were getting laid off. Raises were postponed. Side hustles were becoming survival strategies. Meanwhile, something else was exploding quietly. Retail trading. By 2024 to 2025, individual investors made up 20 to 25% of total US market activity, sometimes even more during volatile days. Millions of ordinary people, teachers, IT workers, delivery drivers, were entering the market. Not because they loved risk, because they were looking for relief. Daniel was one of them. It started with a video, a calm voice, clean charts, a promise wrapped in logic. You don't need to be rich. You just need to be disciplined. Daniel watched it on his lunch break. Then another, then another. Each video told the same story in different words. Institutions manipulate markets. Retail traders can ride momentum. Risk is manageable if you're smart, and Daniel believed that, because he was smart. He deposited $500, not savings, not borrowed, just curiosity. The first trade lasted 14 minutes. When he closed it, his balance showed $623. That number didn't matter. What mattered was how it felt. For the first time, effort created instant feedback. Neuroscience explains this well. Unpredictable rewards release more dopamine than steady ones. But Daniel didn't know neuroscience. He knew this. I finally found something I'm good at. Over the next few weeks, $500 gives $1,200, $1,200 gives $2,100. Daniel didn't celebrate loudly. He didn't tell his wife numbers. He told her possibilities. This could help us get ahead. This could be our cushion. And technically, the market agreed. During that period, retail traders poured billions into US stocks, pushing popular names higher. Daniel wasn't alone. He was part of a wave. At some point, something subtle changed. Daniel stopped thinking in months. He started thinking in minutes. Trades weren't about companies anymore. They were about patterns, candles, momentum. He added more money. $3,000, then $6,000, then $18,000, nearly half his total savings. Statistics say 70 to 95% of retail traders lose money long term. But statistics don't scare confident people. They scare beginners. Daniel no longer felt like one. The market opened red. Daniel entered anyway. He told himself, this is just volatility. Then the price dropped faster. He didn't exit. he doubled down. In 10 minutes, he lost $4,300. His hands shook. His heart raced. But instead of stopping, his brain whispered, "You don't lose until you quit." This is loss aversion. Humans feel losses twice as strongly as gains. Daniel didn't know the term. He felt the panic. Over the next month, he traded to recover. He recovered to trade more. He slept less. He checked charts more at work. He nodded through meetings. At home, he avoided conversations. His account dropped below $10,000, then $7,000, then $5,000. During this same period, U.S. markets were wildly volatile. Jobs, data weakening, inflation uncertainty, rapid index swings. Professionals hedged. Daniel chased. His wife asked gently one night, "How's the trading going?" Daniel smiled. Up and down. Normal stuff. That lie hurt more than the losses. Because now, it wasn't just money. It was identity. It happened on a Friday. High volatility. Big promises online. One sign lifetime setup. Daniel entered heavy. The market moved his way, then reversed. In under 90 seconds, his account fell to $1,247, from nearly $20,000 invested. Gone. Daniel didn't scream. He didn't cry. He stared at the screen until it went dark. For weeks, Daniel avoided markets. He worked overtime, cut expenses, sold small things quietly. The loss wasn't just financial, it was psychological. Because money can be rebuilt. Confidence is harder. Trading didn't fail Daniel. Expectation did. He was sold a narrative. Skill beats probability. Effort guarantees outcome. Losses are temporary. The market doesn't work that way. It doesn't care about effort. It doesn't reward need. It doesn't forgive ignorance. Months later, Daniel returned, but differently. He invested slowly, diversified, accepted boredom, no adrenaline, no screenshots, no rush, because some lessons only come from pain, and the market is a very expensive teacher. If this story felt uncomfortably familiar, you're not alone. Share this with someone who might be walking the same path without realizing it. And subscribe to Beyond the Money, where we don't sell hype, we tell the stories behind it. Daniel didn't beat the market, but he survived it. And sometimes, that's the real win.